Hi, welcome to Trading Without Fear. And this episode is a live trade of INDP. The date is September 15, 2021. And with this stock, what I was noticing was the gap up in the morning. It seems like I had some news and it's also a low flow. I did start to recognize this kind of pattern right here that I do oftentimes play. As I was starting to calculate how many shares I could purchase, and it started to move too quickly, so I didn't want to get FOMO and chase it up. So I was just being patient and watching for another pattern that I can see. Over time, I started making this consolidation pattern and kind of formed a base right here. So I was thinking this is kind of a wedge pattern or a pendant pattern. So I was like, okay, well, I can buy it in at 1950, risking about 6.5%. Soon after I bought it, it spiked up and started consolidating. Now, when I first entered into this position, I used a 15% target for my bracket orders and a 5% risk. I did actually widen my risk to 6.5% based off what the chart conditions show. And I ended up moving my sell target up. The reason why I did that was I'm using last month's data for this pattern, which is a wedge pattern. So the data shows that it has a probability of 45%. But when I look over here and look at the listed wedge pattern, there's a higher probability of getting 30% on the trade. So that's what I was looking for. I wanted to maximize the profit based off the data that I have. So I ended up widening the risk and going for 30%. Now, during this time, I'm actually writing down my trading workbook, my thoughts and feelings on the trade, and kind of what emotions I'm actually having. By doing that and writing it down in my trading workbook allows me to get it out of my head and put it down on paper. It's really good to actually review your trading workbook, once a week, so that way you can see sort of behavioral patterns or behavioral things that you're doing, and it's easier to actually correct those when you're actually aware of what's going on. So with it kind of going up, I'm thinking at this point that there's a good potential that I could break out of high a day and continue on. And so I'm kind of watching it a little bit more intently at this point. I am also currently in a swing trade of IRNT/WS, and it's the warrants of IRNT. So I'm watching kind of both of those at the same time. But my main focus currently is on this stock right here. I do actually have bracket orders and sell orders already in IRNT. And so I'm just watching this one. And the main reason why I'm not recording RINT is because it's a swing trade. It would just be too hard for me to actually record every single day and try to put that together for you. And so on this big red candle, where I'm starting to think it's possible this trade may not work. It's already up pretty much. The news that's on here is kind of frugal. It may not be enough to actually push the stock anymore. And I'm kind of worried whether or not the trade's going to work. But working off the probabilities of my system and working off the data, I'm still holding strong. As long as it either hits my stop loss here and gets me out for a small loss, or it's my sell target, I'm going to just let the trade work and continue on. It did break out of this yellow trend line, and it's holding that pattern. It's holding that different trends, so it can come up and down in between here. So you can see there, I clicked on my stop loss to see what the loss was. I wanted to calculate I wanted to calculate really quickly whether or not I was, accepting that 6.5%. And if you do like this content, subscribe to the channel. I'll be posting any live trades that I'm doing. I don't post every day because there's not always a trade that I'm going to take every day, but these are good learning tools. So now this video is actually sped up by 200 times. It did take a little while for this trade to work. Leave a comment below. What's your favorite pattern? And do you track that pattern often? So it's just a little bit of consolidation. So I'm just letting the trade work, trying to distract myself in some other way just to not get too emotional over it. I was a little bit upset that I missed this good push right here because I would have already been out of the trade. Most likely, it would have only taken 15% out of this area right here because that was a bracket order that I had set up on this section right here. I'm still thinking this risk down here is actually going to hold. What I ended up doing is replacing my just double check to see what the risk level was again. At that point, I'm getting a little bit nervous whether or not it's going to come down and whether or not I was actually okay with taking that risk. And so that risk level was at 1774. And just to quickly do the math again, that'd be a 9, almost a 10% risk, a 9% risk. So after I double check that in my Excel spreadsheet to get the math correctly, I was just debating whether or not I was okay with that. With such a small position size, 9% that the trade work isn't terrible. If I was going to go for the 5% that I was actually looking for, I'd have been stopped out on this downwards candle. And the reason why I widened my risk is because that's what the chart told me to. I did buy it up a little bit here, so by getting into the top end of this, consolidation right here when I had a breakout, that's kind of where I determined that the risk would be better to actually put it down here. So I'm okay with that as long as the chart is holding and as long as the trend is holding up as well. I'm okay just accepting that 9% risk. And I am bouncing back and forth between screens. I do have a dual screen system, so I am watching a swing trade that I'm currently in, and that's IRMT. And I didn't record that one just because when I first got into it, I did record it. It was an all-day recording, about 6 hours, and it kind of just didn't do anything on that day. So I stopped recording it. Didn't really want to upload it because nothing was happening, but my risk was never hit, and so I just decided to swing trade it and let the trade work over time. And I'll post a review on that trade once that trade is finished, whether it gets out for a profit or a loss. Currently, the trade's doing pretty well. And so with INDP, I do know that it has a history of spiking and falling. You can see a couple examples of that right here, where it has a spike up one day, gives back all of its gains, and then gaps down, consolidates, spikes up, and on this day, it ended up giving back all of its gains. And it just kind of has a bad history of doing that. So I do think the only reason why this move was actually happening was because it's a low float and people were buying it into wrapped up. And if you didn't see INDP on the 15th of September, go back and watch the price action, or go back and just kind of what it ended up on the day. This is a kind of a scary stock as far as what the history does. So that's one of the reasons why I'm a little bit nervous whether or not this trade is going to work. There's a good chance that this could be the top and it could ultimately fail. The trend is actually starting to make some higher lows here, and higher lows here. The volume is starting to die down. You can see the dwindling volume in this area. So with the volume starting to die down, it's starting to push back up. And that's one of the things I'm looking for. A lot of newer traders start to put a lot of emphasis on like I said, the level twos and too much emphasis on the volume, you can actually have light volume and have it push up, especially on low float stocks. And as the volume starts to come in and push up higher, that's what you're looking for, is those increases in volume. But you can see with the volume starting to dwindle down, the stock is still somewhat uptrending. Now, with me being a passive mechanical trader, basically what that means is once I'm entered into the trade, I can't really change much of the parameters of where my buy and sell targets are. It's going to have to hit either one of them, and in between what's going on, I just have to deal with the emotions. One of the great things that the mechanical trader actually does, and right here I just took a screenshot post on Twitter. One of the great things that mechanical trading does is actually teach a trader how to become confident in a trading system. And so that way they can actually move up to different forms of trading, such as subjective trading or intuitive trading. And for a lot of newer traders, it'd be better to actually start off as a mechanical trader and then slowly work your way up into intuitive and then subjective and then intuitive trading, versus just trying to jump into subjective trading. And the difference is as a mechanical trader, I put my risk in there, put my stops on there, put my sell target on there. Either the trade works or it doesn't. As a subjective trader, as the trade's starting to form, I can determine whether or not, based off emotions, past experience, and chart and price action, I can determine whether or not I want to stay in the trade any longer. And let's say if the trade was starting to come down, let's say on this candle here, I think that's going to actually fell. I can cut my losses, and if I need to, I can rebuy back at a different price. As a mechanical trader, I can't do that. So for me, mechanical trading is the way to go. I may actually stay in mechanical trading for the rest of my trading career. It just makes a lot of sense, especially the way that I've developed my system. And so what I started noticing here was that it was basically making an ABCD pattern. I changed from a wedge pattern to ABCD pattern, so it started making some higher lows and higher lows. So I changed the trend line to match that ABCD pattern, so it's a little bit easier for you. So this right here is the A, B, and then this consolidation right here would be C. And if I wasn't entering into this trade, you can buy anywhere around this area, risking off of the lows up here. And if it breaks down below this area right here, there's a better chance that the stock ultimately falling. I actually put my risk below these breaks right here, and then the trade work. If it breaks out of the 21 range, there's a good chance that the stock can continuously push itself up. So that's actually what I did, is I ended up moving my risk up to underneath those wicks. That's one wick right here. That way if the trade does fail, instead of it being 9%, I'll be closer to that 5% range. And again, still light volume, but it ends up pushing through the breakout level of the 21. Volume starts to, still be light. Just watching to see if the volume comes in. Watching level twos, there's not much information where you can gain from level twos. Especially on listed stocks, they move pretty quickly, and some people can actually use the time and sales tape. For me, it just moves too fast, so I just use the price action pattern and data to actually determine what trades I'm going to be entering into. Now, what ends up happening on the ABCD pattern, I'm seeing this a lot lately, where a lot of newer traders are calling this a spike consolidation spike pattern. And what they're doing is they're actually buying at the top of the range right here. And one of the reasons why you don't want to buy on the breakout is you're no longer playing the ABCD pattern. What you want to be doing is actually buying during the consolidation period and risking off of a key level of the chart. On certain patterns and certain market conditions, that top will actually act as a resistance. And so if I had a larger position size, I'd be selling half my position when it breaks through that level, and then letting the rest ride. But if you're buying at that level, oftentimes you'll be buying the top of the move, and there could be potentially 10, 15, 20% on the downside to actually get out of the trade. And so just give you an understanding of what I'm talking about on that one. The key level where you should be risking off of and where that breakout is at, the difference between the two is at 14.86%. So it's really bad to actually buy on the breakout, oftentimes because you may not get the fill because it's going to move so quickly through that breakout, which is one of the reasons why it's better to actually buy during the moment's consolidation as it's starting to push up through that before it actually pushes up through that. And what you want to be doing is buying pretty much around these areas and risking off of here. If you're buying through this push, you may end up accidentally chasing it or get a bad fill and getting it too high. And when it comes down, and you could be risking off this area, but when it comes down and actually hits that area should act as support. With listed stocks, they act kind of choppy, so support levels on these are a little bit difficult to actually read. But basically on this stock right here, the support should actually be right here. The support should be right here, and right here should be acting as support on this. And you can see this nice upward trend. So if you're buying it here and that trend breaks through and ends up coming down below that trend line, there's a potential of a 15% loss. So it's always better to buy during moment's consolidation. So you can see here starting to approach my sell target up here at and let's just see if you can push through it. There we go. I am getting out for 30% profit with 5 shares at $29.25. And that's pretty much it for this video. If you like this content, subscribe to the channel, and we'll see you next time.